Welcome back. Yesterday, the Monetary Policy Committee decided to reduce the CRR, that's the cash reserve requirement, on public and private sector deposits from 31 to 25%, but maintained the monetary policy rate at 13% and liquidity ratio at 30%. Of course, most analysts had anticipated this move by the MPC, but how much of an effect is this going to be having on the economy? We're trying to understand the issues this morning. We're talking to economic analyst and managing director, CEO of financial derivatives company, Mr. Bismarck Ruwani. Good morning to you, and thank you so much for coming in. But just before we start this conversation, let's quickly listen to the CBN Governor, Godwin Emefiele, as he made this announcement yesterday.
The committee noted that the overall macroeconomic environment remained fragile. The economy further slowed in the second quarter of the year, making it the second consecutive quarterly less than expected performance. Committee noted that growth had come under severe strains arising from declining private and public expenditure. In particular, it noted the impact of non-payment of salaries at the state and local government levels as a key dampening factor on domestic demand. Year-on-year headline inflation continued to trend upwards, although the month-on-month measure moderated. Demand pressure in the foreign exchange market remained significant as oil prices continued to decline. Arising from these developments, there were indications that some of the banking sector performance indicators could be stressed if conditions worsen further. Specifically, committee noted that liquidity withdrawals from the implementation of the Treasury single account, elongation of the tenure of state government loans, as well as loans to the oil and gas sectors, could aggravate liquidity conditions in banks and impair their financial intermediation role, thus affecting economic growth unless some actions were immediately taken to ease liquidity conditions in the market. Having seen 2 consecutive quarters of slow growth, committee recognized that the economy could slip into recession in 2016 if proactive steps were not taken to revive growth in key sectors of the economy. In the face of prevailing circumstances, committee acknowledged that synergy between monetary and fiscal policies remained the most potent option to sustainable growth. The committee further observed that the impact of the persistent decline in global crude oil prices on the fiscal position of government continues to reflect in rising credit to government. The committee also noted that the initial market reaction to the decision by JP Morgan to exclude the country from its government bond index for emerging economies had largely dissipated as yields soon adjusted to their pre-announcement levels, adding that there may be second-round effects over the next 2 months as the economy adjusts to that decision.
Governor of the Central Bank of Nigeria, Godwin Emefiele, there reading out the decisions reached by the Monetary Policy Committee at the end of its 2-day meeting in the Federal Capital Territory, Abuja. Bismarck Ruwani is still here with me in the studio. Mr. Ruwani, listening to Mr. Emefiele, talking about the reasons why the decisions were reached, what immediately came to your mind?
A committee that was concerned about variables that are outside their control. 1. 2, but the most important thing were the 3 variables that we're looking at. 1 was slowing growth, 2, inflation, and 3, the large elephant in the room, the exchange rate. So let's take number 1, slowing growth. So growth had dropped to an average of 2.3% in the second quarter, with a threat that it would go down to about 2% in the third quarter and probably 1.8% in the fourth quarter. At that point, we see a point of inflection where you begin to see a gradual uptick. The definition of a recession is 2 consecutive quarters of negative growth. The probability of us getting into that situation is extremely remote at this time. Therefore, I think that an accommodative monetary policy stance, which is what was done by reducing the CRR, is stimulative enough, but it has to be backed up with fiscal policy, which means increased expenditure, at times increased borrowing, and out of that. And the joke, economic joke about what is a recession, is that when your friend or your neighbor loses his job, it's called a slowdown. When you lose your job, it's called a recession. When an economist loses his job, it's called a depression.
So, where are we right now? Because
we're in a slowdown.
We're in a slowdown.
Yeah.
But looking at the variables that he actually pointed out, it seems as if we're tending towards a recession. And now with the reduction in the CRR, a lot of most analysts were actually quite excited about the fact that that means there'll be more liquidity in the system.
Absolutely.
And then he was talking about the fact of the banks making sure that they begin to join hands in reinvigorating the economy, so to speak, especially key sectors of the economy.
Well, one of the things that central banks have been asked not to do is to try and allocate credit. Credit allocation is the responsibility of the banking system themselves, and it's a function of the risk in a sector. So the fiscal elements, by providing infrastructure, right now electricity is much better than it was before, investing in roads for distribution network and all of that, those things will happen. And banks will lend voluntarily towards those sectors. They'll be encouraged by incentives, i.e. giving them special funds or intervention and all of that. But the job of the regulator or the policymaker is that he has set the tone and the context and has alerted the public to the fact that these are some areas that need concern. But it's when you have a fiscal team in place, which is the Minister of Finance, directors and all of that, you will then have synergy between fiscal and monetary policy, and which will actually align monetary policy with monetary conditions. The monetary conditions were already tight. So what he has done is to ease it, and that's the committee. And that is exactly what should happen. But
in taking this position now, like you rightly mentioned, there's supposed to be a fiscal team, on hand with fiscal policies to kind of work side by side with these monetary policies that are being rolled out. So do you think that the MPC should have taken the decision at this time without fiscal policies, without seeing an economic team in place, or should they have waited?
No, they don't have to wait. You see, the Monetary Policy Committee meets every 2 months. There's what we call instrument autonomy. The central bank has deputy governors and a governor. They work day to day. So if, for example, the price of oil was to drop to $10 today, they won't call the Monetary Policy Committee to meet. There might be an emergency meeting. They will take steps. The Central Bank of Nigeria intervenes on a daily basis in markets, in treasury bill market, in foreign exchange market and all that, to maintain stability. Main goal is to maintain stability, targeted, especially price stability. That is the overall and the most important objective of central banking, because we have what we call the inflation targeting monetary policy framework, which is used to determine all the actions. And that is what the economists will look at, but the layman would be just looking at prices and all the other things.
So now, in terms of the actions taken by the CBN, what are your thoughts? Do you think it is a step in the right direction with regards reflating the economy? Because that's what a lot of talk has been about, reflating the economy.
Yes, I mean, that is the direction. You see, but you see, the thing is that an economic patient is the same thing as a medical patient. There's diagnosis, there's therapy, and then there's prognosis. So what has happened is that we've been diagnosed with slow growth, we've been diagnosed with inflation, which added together is called stagflation, and we've been diagnosed with external imbalances because our foreign exchange rate is out of equilibrium, right? So how have we treated this? We've taken number one with accommodative monetary policy to inject liquidity. The banks will have additional liquidity. It will also reduce their cost of funding. Was it enough? I think that going to 25% move in the right direction, but they should have gone further. Because right now, the money that has gone out of the system because of the TSA had a net negative about 230 billion.
Yeah.
The money that comes in is about 700. So you have a net positive of 500. But the banks were already in a tight position in terms of their dollar and naira deposit liability structure. So that helps, but you have to do more. 2, is it going to affect their NPLs, their non-performing loans? Because that's a major problem there. And if those non-performing loans are not addressed, then there'll be write-offs, which will affect the capital adequacy of the banks. So that's banking system stability also being addressed, liquidity being addressed. Now, we have to go back to how long, what's the transmission time between when these actions are taken and when the effect will be felt by the public? That is where the question of a fiscal team. If there's no fiscal expenditure and fiscal revenue measures to complement this monetary policy package, then the results will be suboptimal. So we are assuming that within a week or so we will have, in fact in the next few days we'll have a cabinet. Cabinet will sit down, there will be a supplementary budget, and then you begin to see the impact of all of this put together. Right now, most of these discussions as to whether we'll have a recession and all that are hypothetical, in the sense that we do not really know how much. For 4 months, there's been no Federal Executive Council meeting to say, these are the contracts awarded, this and that. It was cleaning up time, house cleaning, and that has been done. Now it's time to take steps in the right direction, right? And then we now begin to ask yourself, in all of these things, there's a key element, which is the exchange rate. If the exchange rate is in disequilibrium, then it leads to distortions. How do you put an exchange rate in equilibrium? Either by market measures, which is more efficient, or administrative measures, which is difficult and can be abused. Okay, so right now, because there's no fiscal team, because there's uncertainty as to what the direction of oil prices and where the level it will be, administrative measures are being used as a temporary measure. The central bank governor did allude to the fact that, and kept the window open, that we continue to look at the pricing of the exchange rate, right, at this time. But the point is that we do not have too much time. In fact, we are on borrowed time right now. The exchange rate adjustment will have to be made sooner, maybe, than later.
We'll take up that point when we come back after this quick break. Mr. Rwani, let's catch our breath and come back and continue the conversation. Yeah. Bismarck Rwani will still be here with me when I return in just a moment. Stay with us.